Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over, I know a lot of people ask, when do you sell? When is this done, this trade or investment? And what should we be looking for? What is the cycle of the progress of this investment? And what I'm going to do is I'm going to go over a couple of things. I'm going to mirror kind of previous cycles and what they look like and when it was time to sell for them. And then this cycle, it is different. It is very different. And the differences are really what's driving it. And we still have the same drivers, but we've got all this manipulation thrown into the mix. So it makes our indicators all kind of jumbled up and messy. And I'll go over kind of some of this, I'll go over it right now about what is different between this cycle and other cycles. So the pacing factor of other cycles were the demographic. A larger demographic came into home buying years, and they came into peak spending years. They came up through, and that money was put into the system through credit. It was credit expansion growth of the M2 money supply. And that M2 money supply was the inflation. It was a larger amount of loans coming into the system. Now, this time around, it wasn't all from loan growth. It came from a bunch of stimulus money that came into the system all in one shot. So we had the demographic. We have the demographic coming into home buying years. We still have those forces and pressures, except we've got the stimulus money that was all thrown on top of it. And the stimulus money is driving a lot of that inflation. Now, that stimulus money may, and I don't know for a fact here because we've never had this type of stimulus in the system before, it may push interest rates to a level that the housing market doesn't like for a period of time, which would drastically slow the housing market down, even though the demographic is coming into home buying years and wants to buy. So the pacing factor may or may not be the stimulus money or the demographic. And given the interest rate, which is kind of it's the self-regulator of the free markets, I don't think the Federal Reserve is really doing anything. That's my take. They might be playing with like financial products. That's fine, like QT and all that. But they don't necessarily regulate the interest rate. Everyone thinks they do, but what are they going to do? Come out and buy a bunch of bonds and hold the interest rates down? Is that what their plan is? And it's going to be inflationary if they do that. Why? Because as people sell bonds, whomever they are, the other end gets cash in return. That is inflationary. So I don't think that they're controlling this cycle. They hadn't in the past. I don't think they're controlling it now. I think it's the demographic coming into home buying years that ultimately determines where interest rates end up. Then another determining factor, which is also outside of the Federal Reserve's control, but it is a variable, is how much debt is in the system. And inflation and hyperinflation are just a relative measure against other currencies. So if everyone's in this debt game and they're all, in a monopoly or pact saying that we're going to all increase our printing of money to reduce our debts or make the debts more manageable or serviceable, then we just get inflation everywhere. So let me go through. I've got the quadrant behind me. That's what you see. We're going to go through a couple of slides, and I'll kind of tell you what's different, what's the same, and kind of my opinions on all this. So let's dive in here. This is what the quadrant is. This is basically the business cycle. The business cycle is This is here. Let me go to the next slide. This is a recession, recovery, expansion, and hypersupply. Based off these quadrants is basically where you want to be invested. And right now, we are in an expansion phase by definition and we have not gone into a hyper supply. But we've got this weird thing going on where they sent money out to everybody, and it was a lot of money. We increased our money supply drastically from the stimulus. And what happened is it's like we're stuck in an expansion phase, but we're not really expanding. We also have supply chain problems. We've got all these issues out in the market. It's really slowing down the expansion phase. In this expansion phase, you want to be invested in this stuff over here. It is accelerating growth and rising inflation. I think that we are traveling backwards this way towards slowing growth with high inflation. So we're somewhere in this upper quadrant, in this general vicinity, traveling from right to left. And what I think is good is commodities and gold, commodities and gold. And this is a late stage, when they mean by that, a late stage investment is somewhere from expansion to hyper supply. It's in these quadrants up at the top here. Declining vacancy, new construction, that's exactly where we're at. We do not have increasing vacancy and new construction. We've got tight rental markets. We've got tight home prices. But the interest rates have gone up dramatically in a short period of time because of the stimulus money. That's your disconnect. Your disconnect is money coming from an external factor, the Federal Reserve being printed, into the system, causing an abnormal interest rate for a short period of time. I've talked about this before, where we would have high inflation, we'd have disinflation, then we come back to a new level. That new level is the sustainable portion of the millennials coming into home buying years. Because I don't think we've built the homes. This phase always ends in a bubble, usually a bubble in real estate with a hyper supply. The problem is we don't have the hyper supply, and the housing market's slowing down because of an interest rate that is at a level to slow down stimulus money from a human entity putting it into the market. It's not a self-balancing mechanism. It's a mechanism that is slowing down a human-made problem. That's a huge thing, a huge takeaway here. So it makes it difficult to say, when the interest rate goes back down and we go to a new sustainable level, we could see a messy transition there because we never went into the hyper supply phase. So I think we are very much, and then we go to the housing starts. I think we're very much in this phase here where we have like a pullback in the early 2000s and a potential recession here, like the early 2000s and the NASDAQ bubble. And there's going to be slowdowns and problems because of energy in the system, the energy crisis. So I think it's going to be much like the early mid 70s as well, where we slow down and we may get another boom behind it because we never really went into a large boom for the millennials and home buying years. We have a slowdown because of those interest rates fighting the stimulus money from an external factor. These were all self-balancing mechanisms in the market outside of this lowering of interest rates blowing up that housing bubble where they just gave out free loans. So this is the cycle here. We're looking for these expansionary phase cycles. This is where commodities do very well, and precious metals, commodity, precious metals, commodity, precious metals. And we are coming back down. Once we go back below the average, we are out of that expansion phase, even though we could be riding the line for a while, much like this line here, or something like where we ride it for a little bit. This here was more or less your inflation coming into the system. The Federal Reserve wants to stop that. That's why they're raising interest rates at a fast pace, because they want to stop the flood of money coming in to the system. They want to slow down inflation is what their stated goal is. And the markets, because we've got the money in the market, it's going to force those interest rates higher as well. And that's what they're trying to do. They're trying to solve this problem from a demand standpoint and slow the money coming into the system. We still have the energy crisis, which is going to rotate money in the system into energy and into commodities. That's your problem and what's really different this cycle. So again, we are in an expansion phase, which is a seller's market of real estate, decreasing vacancy, mod to high construction rates, moderate to high rental rate growth, which we have all of that, moderate absorption. We have all of this in an expansion phase. We're seeing this cycle play out in front of our eyes with rental rates going up and construction rates going up. They've had some weakness in the short term over the past couple of months. We have to see if that weakness continues and if we enter into a hyper supply phase. But I just don't see how we go into a hyper supply phase with no supply yet. We are in a weird scenario in an expansion phase, which is getting stopped by an interest rate that's gone up to slow down man-made inflation. It's not a market-driven inflation. And then we have the energy crisis on top of it. And this is recession from the housing market. This doesn't mean that we can't have a recession in an expansionary phase of real estate where they deem it a recession, kind of like the NASDAQ bubble. And I've got some charts here. Yeah, those are kind of all long-term, but I want to skip to, these are the market balances back here, but I'm going to skip to this one here. And this is the copper, aluminum, zinc, nickel, and this is the inventory of these commodities. What do you see? This is a left to lower right on all of these different commodities. They're all being drawn down. Nickel, zinc, aluminum, and copper. They're all started at pretty high levels in 2021. And these are all drastically coming down into very low levels. Does this look like a recession to you? Does a recession draw down your copper, aluminum, zinc, and nickel? Does it draw it all the way down to the lower right where we have no inventories of this? And remember, this is stocks and weeks of consumption. We have really less than 2 weeks of consumption in nickel in all of these, less than 3 weeks for sure. That's crazy low inventory, guys. That is crazy low. This is going to cause a rotation of money into commodities. And I've started looking at all this, and I don't think that it matters what the other markets are necessarily doing. I don't think they can slow this demand. I think that we have a supply problem across the board in commodities. We have a supply problem in energy. I think that they're literally shutting down China because they have an energy shortage. So they're doing lockdowns not because of COVID. They're doing lockdowns because they have an energy shortage and they don't have enough energy to do anything. So they said, oh, let's just lock everybody down. That's what I think they're doing. They've locked down over 300 million people in all these different cities. We're entering a period where I don't think we've ever seen an energy shortage all the way back till I don't know when. And commodities, I think a lot of people think, well, we've got this stuff in the earth and that things will get solved. I'm not so sure that this will get solved in a timely manner. I think we're going to be short for a long period of time. And that's going to drive an increase in the pricing of real things. So here's the difference here. All right. This is the big difference between these different time frames. The 1970s, we had an energy crisis, but it was only contained to the United States. We had the demographic coming to home buying years. The variable here was the demographic and the money coming into the system from credit growth. And we had the entire world around us that had expanding energy. We had expanding commodities. We had expanding everything. And it was all outside of the United States. We had expanding stuff inside the United States as well. Natural gas could expand. All these things could expand. What we could be coming up on, I say could because I don't know for a fact, we could, and what's different with this cycle that's coming is that we are having not just a demographic coming into home buying years and the M2 money supply and this fictitious M2 money supply growth that they threw into the system all in one shot. What we also have is a coinciding energy crisis on a worldwide scale. We've never seen that before. We've never seen an energy crisis on a worldwide scale. Now, if Russia started producing natural gas again, would this crisis go away? I don't think so. That natural gas is still getting to the market. That oil is still getting to the market. They are still selling it to India. They're still selling it to China. It's the entire world, especially some of these third world countries, India, China. They are growing in their S-curves of their energy consumption. I don't know if there's enough energy out there to meet the flow rates of what they want. So we're going to be building absolutely everything. But a lot of these solutions have copper, aluminum, zinc, nickel, all these materials, which are going to be short. And I don't know if we can just go out there and find a bunch of new mines and massively produce from these new mines. I think that the demand will exceed the supply for flow rates for a long time. And I think that's going to happen in just about everything. And I don't know if we've seen this in history for any length of time. We usually have had plentiful areas that we could just go plop in, get a bunch of oil, get a bunch of natural gas, get a bunch of whatever. And maybe those areas still exist, but I think they're going to be localized. I think we're going to have to do a lot more shipping, a lot more moving of things around the world. I don't think we can produce 200 million barrels a day of oil. I don't think we have enough reserves out there. I don't think we can drill fast enough to get to a level of 200 and have it be sustainable. So we're definitely less than 10 years, 20 years out of oil, of peak oil probably. And we've got all these inventories declining of real minerals, of real things. I don't think we can ramp up solar and wind as much as we think we can. We can ramp it up, but we're going to be constrained to mineral usage. So what's going to happen is our model of what has worked in the past of the demographic, hiring interest rates, and then slowing down that demand for loans and M2 in the money supply through interest rates, which is the self-regulating kind of factor in the system. I don't know if that's going to fix the supply side problem of all of this stuff here, because we haven't seen it like this before in history. We don't have a playbook of what necessarily happens. So I think economies have to go into recession because we're going to be short minerals and energy. Energy is the feedstock to growth. And if you don't have that feedstock, I don't know how you can grow. And that right there is the problem. And it's also the problem to figure out when to sell. Because you're going to see things slow down. It has to. You're going to have to see things get destroyed where the energy markets come into balance through the destruction of demand. So they're raising rates, but what's tricky is when people figure that out, we could see currencies have problems. And then they're going to have to come up with solutions on the energy side, and I think that's where the biggest investment opportunity is, where the largest problems in the world has faced, and I think it's in energy. You've heard me say that before. So I think we're in the quadrant. I think we have slowing growth going to the left. This is usually where gold and commodities do very well. The ratios of all of these are still incredibly cheap in the system. The money has not rotated in great amounts into commodities and precious metals yet. We have not seen the rotation of money in anywhere near the 1970s. Back then, we could see that the money rotated into commodities and accounted for the money supply. We have not accounted for the money supply yet in precious metals. And the ratios of commodities and oil and all that stuff is not at highs. We are at average levels of about 20 to 1. 20 barrels of oil to 1 ounce of gold. So I don't think that the money has rotated yet. I think we are still very early in this problem, solving these problems. And that we still have a lot of runway ahead of us. If you guys need help navigating these markets, definitely become a platinum member in the website below, finding-value.com. That is what I am helping people with. And you can see my portfolio. You can see the companies that I am playing. I post them. I do midweek updates. I do a question and answer session every weekend. We talk a lot about companies and the charting. I am going to have a technical analysis training session next week. Not this week, but next week. I'll get that scheduled up and put it on the website. And if you want to join all that, join. And I've got all these charts up here with stocks of weeks of consumption and inventories. I put it during our midweek updates and all that stuff. So you stay updated with what's going on. If you want to become a successful investor, what should you be looking at? You should be looking at inventories. You should be looking at technical analysis to see what the markets are doing. You got to be looking at ratios. Those are basically the three pillars: market conditions, technical analysis, and ratios. And I can help you do that. If you guys like this content, give me a thumbs up, subscribe to the channel, and we'll catch you next time. This is Finding Value.